Oppenheimer's chief investment strategist, joins us here at Post 9. John, great to have you with us.
Great to be here, Melissa. Thanks for having me.
What was that moment when you said, I got to go to a street high of 4,900?
It really occurred a few weeks ago, and then we held back. We waited for some economic data to cross the transom, whether it was last month's jobs or the prior month's jobs, whether it was the continuing claims, or whether it was initial claims, what have you. And then the GDP number, I think, really added to confirmation that we saw last week that there is strength in this economy, that the Fed has been remarkably sensitive, even though on a nominal basis, the hiking has been aggressive. When you consider the inflation, the dangers of free money to the system, where bond issuers don't pay for the privilege of borrowing money. This is a normalization process, a big shock generationally to many people who were not in the markets in 2008 and may have been in high school or are now in their 30s. But the reality is, for those of us who've been here since I'm 83, this has been, this is a normalization, is what we see really here. And we think the Fed will, calm things down. We think Powell has done a remarkable job. And the irony is the overstimulation by both the Fed and fiscal policy of two administrations is likely helping the markets, the economy, the consumer, labor to weather the hike cycle remarkably well, and it's reflected in the equity market, we think, in particular.
You cut your 23 EPS to 220 from 230 for the S&P. Hence, you're happy with a higher multiple, willing to accept it when you're at 4,900 now. How do you justify that?
David, I think when you look at a multiple, especially at this type of point where you're in transition in what is a recovery market from a bear market, you've had declines in earnings. Coming out of it, inevitably, if analysts are looking ahead for the next 12 months, that a price target doesn't look bad and the multiple doesn't look bad because we expect earnings will work off that high level.
So 24 is going to be a lot better than 220.
Yes, we think 24 will be a lot better than 220. It's just that 230 was a little bit optimistic for this year, so we shaved it a bit.
Is there any concern about, we talk about the Fed's last mile, this little bit more in terms of rates? We know that we're much closer to the end than we were, just 3 months ago. But still, it could be very rocky. The inflation reads won't be straight down. There could be hikes along the way at periods where we're not expecting them. Does that matter, that this is actually a very tough sledding for the Fed, this final mile, and yet you're going all in bullish?
I think, the thing is, our all in, we're intermediate to long-term investors, as you know, from working with me across the years. It's in effect, our goal is beyond. We feel comfortable with this 4,900, whether it's recognized by year-end specifically or into the first quarter of next year. But that said, the market is usually late in the cycle of a hike cycle. The market finally gets it that the Fed is not trying to destroy the economy or the markets. It did it in 1994. 94, the tech dropped, I think, 20% in the first quarter, and it was up 20% for the year by the end of that year. Go figure, And in 95, the Fed actually cut, and that was a different story. It was good for the markets as well. Well, we, as equity people, we look a lot at the Fed, and the leadership is important, the Bernanke legacy, the advancements in technology that creates efficiencies for business and for the consumer to navigate tough periods. We think we're coming out of the woods. We're making good progress, and the light outside is not an oncoming locomotive, but sunshine.